All right. So you keep hearing that rates are dropping super low, and you're trying to figure out why the rate you see online is not the rate you're getting quoted to by your lender, or if you and a friend went through the exact same lender and all of a sudden your rate's 0.25% higher than theirs. What's going on? So we're going to talk about that a little bit. Now, what goes into rates is what's called LLPAs. We're going to dig into that a little bit today. And just to be real with you, the rates you see online are not necessarily accurate or average rates. And I'm going to start this off by saying we're going to go straight to Mortgage News Daily here. And we're just going to look up where our current rates at. Now, realistically, what on current mortgage rates, it's going to have this answer to this is how we do our charts and data from local lenders, la-di-da. What's interesting is what they're showing you. First off, they're not always including points and fees. Second off, they're also being literally given rates from lenders. So the lenders are reporting their own rates, and they may or may not be reporting what they're making on it, depending on the points and fees, depending on what they're charging on the back end, if there's anything on the back end at all, if you're paying any sort of discount points, or if there's margin included in those rates. You're not seeing that. You're also seeing a lot of these are come from, if you literally look through this, you have Veterans United is the top one on it, and they don't even have a rate available. Then you have District Lending, Philo Mortgage, Nation Home Loans, Tonal Mortgage, Zoom Loans. Like most of these are online lenders. And the only ones that aren't online lenders for the most part are sitting here on a 30-year fixed, and it's not really giving you a ton of information on what is the average 30-year fixed. The average credit score that's being thrown in here is almost 760, 780. It's not giving you, it's giving you 20% down options. There's just so much going on here. It's also not telling you if it's a first or second home, if this is the only financing they have on their home is they only have one finance versus two or three or four. There's just so much to this. Let's just start off with, I got into this industry and I would check Mortgage News Daily, and I would literally go out and send all my realtors, my clients, and say, hey, this is where the rates are currently at, is about here. And then I would have those clients send me referrals. And to be honest with you, this is 4.5 years ago, and I'm trying to figure out, all of a sudden I get a referral from a realtor and or a financial advisor, whoever, and I would send them a rate in the morning, be like, hey, this is the national average. This is where rates are at. And they'd send me a client, and I'd pre-approve the client and say, okay, this client is here. And I'd say, hey, why is that 0.5% higher? And then the client who came to me because the realtor recommended that I get them this rate, all of a sudden was upset because the rate that I'd quoted or given a national average to, which they would consider a quote, was not the rate they were getting. And that still happens today. And I'm still dealing with this. Every single client says, hey, a quick search in ChatGPT or a quick jump on Mortgage News Daily or a quick jump on Google search saying, what are the average mortgage rates? Why is that rate so much lower than where my current rate's at? And so that what kind of just brings us into this idea or this concept of LLPAs, which are loan level pricing adjustments. Now, basically, there's a couple different parts of this. When you're looking at a rate, you have two main things. Number one is the LLPA, which is your loan level pricing adjustment, which are adjustments based on credit score, loan to value, debt to income ratio, property type, whether it's a manufactured home, a duplex, a PUD, a single family, no matter what it is, and then your occupancy, primary versus like a rental or an investment property. Now, with all these LLPAs, it's going to change pretty drastically, especially and very specifically on conventional loans. Now, these conventional loan LLPAs are going to change a ton, specifically on credit score, down payment amount, and the debt to income ratio. If you're in the best category for all these, obviously you're going to have that 6.3 that you're seeing on Mortgage Rates Daily. If you have an 810 credit score and you actually have a lower DTI and you're putting 80% down, then obviously your rate's going to be probably quite a bit lower than that even. Now, other end of that, if you don't have the best credit, maybe you're in the low 700s to high sixes and you're putting minimum down 3 or 5%, your rate's going to be quite a bit higher. You're also going to have a much bigger mortgage insurance, things like that. And especially if your DTI is right at that 49%, again, what we're looking at on this end, there's so many different things that change. Basically, what you're looking at is risk factor. How much risk are you to that bank? They're going through a bunch of your credit worthiness, your down payment, your income, the property type. They're looking at all that and they're saying, what is the risk we are taking as a bank? They have their rate that they're being given. Now they have to add in or subtract different margins to be able to basically take on that loan based on the risk analysis.